We were in negotiations.
Investing in real estate, they're winning, they're making money.
What's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you can build on. I'm your host, Kevin Amolsch. This podcast has been so much fun. We're helping real estate investors and real estate educators. So if you're out there trying to buy rentals, fixing and flipping, or if you're providing content to real estate investors, maybe you're trying to capture some real estate investor business, this is the podcast for you. I have a very special guest with me today, Shauna Green. You know, we've shared a stage together at the Great Mile High Real Estate Investor Success Summit. I don't know if I got that right, because that's literally the longest conference name in the history of conferences. But I think that's right. And so you and I were both speakers at that event. So I know you know your stuff. We haven't worked together on anything that I know of, but you're a real estate investor insurance agent, right? Insurance broker.
Yeah,
So
all
you
these long names.
specialize in working with real estate investors. And I know you do a lot of business with contractors, a lot of fix and flip type insurance. So we're going to get into all of that. But first, let's get to know you a little bit better. So I
right.
know your family was in real estate. It sounds like quite a bit of, uncles, aunts, parents, all of that. So take
Mhm.
me back. How did you even get excited about real estate investing?
I don't think I started out being excited because I was the one who was helping my grandpa re-roof and do irrigation. And I cut the line when he tried to tell me that I needed to get into a septic tank with him. There's no way. But it transitioned into a knowledge that real estate is a really solid place to be for building wealth. And it is a great way to provide for a family. And so I think that transferred over into a love because I also love the people who get involved in real estate investing. They just have a different mindset and they think outside of the box.
Okay, so you became an agent, insurance agent first, and then you started to specialize in investing. Is that how the timeline went?
Yep, yep, it is. I actually officially fell in love with real estate investing, the people, when I found Rig through Jim Eddingfield. Once I walked into that room, I just felt like I was home. It felt like I was with my grandpa and all of his buddies, and I knew that was the place I wanted to be. And so I jumped in head first.
So RIG, for the listener, is a real estate investment group. It's a real estate investment club in northern Colorado.
Yep.
So
It's a pretty great one. I'm
you
actually
and
part of
I,
the advisory board now, so it's something near and dear to my heart.
yeah, and I've had both Tim and Jim on the show, and
Mhm.
we help promote that Mile High Real Estate Investor Success Summit on the show. So they've both had an appearance. I've known both of them for years and years and years,
Yeah,
and
they're
I've
great
worked
guys.
with both of them. So you're a Colorado native. I'm a Colorado native. Our audience is more national, although there's a focus in Colorado and Minnesota.
Uh-huh.
Most of the listeners will be from one of those two. Um, so you started as an agent. So I wanted to take us back to the investing, but you didn't start there. You started in insurance. So take me
Uh,
back to that. How'd you get into insurance?
Well, my grandpa is a district manager, or was, for Farmers Insurance. My two of my uncles became district managers. The rest, even on my mom's side of the family, became agents. I have a cousin who's an agent. I stepped outside of the captive agency and leapt into the independent side just because I realized I could offer a lot more for my clients. And I'm really grateful I did because I feel property investors specifically, they really need to have somebody who's independent and offers more flexibility and choices with carriers because some of you guys are doing some crazy stuff. So,
Yes. Yeah, one of the top mistakes I see investors and private lenders make is improper insurance on their fix and flips, and it's
amen.
because of that vacancy clause. So I've seen people lose money, Shauna,
Yeah.
because of this. So can you help me understand what is a vacancy clause and how do we protect ourselves against that?
Well, you need to have a vacant policy. So, and that's something actually that I can talk a little bit more in detail about. There are two different kinds of policies that you're going to want to look at if you are specifically doing a builder's risk. Fix and flip. One is builder's risk. The other, you can look at a regular home policy that has renovation endorsement on it. But I will tell you, for a fix and flip project, the best way to go is a builder's risk policy because it's going to cover things like your property in transit. So if you have one of those expensive doors, or you went really fancy with your tile and your truck gets in an accident and it's spread across the highway, you actually don't have coverage on that unless you have a transit endorsement. Something else, if you have materials out in your backyard, or maybe well, we'll just stick with the materials. If it's not actually installed, it's not covered with a regular home policy. You have to have it installed for it to be covered. There are a lot of times when you leave the property, you left something in the backyard thinking that it was safe. Somebody hops the fence, gets all of that decking material, it's gone. It's not covered. Some of the other coverage changes would be your policy is typically finished when the project is completed. Now, that's not always the best situation to be in with a fix and flip. With builder's risk, it actually allows you to have coverage past that point. So as you're showing it, you still have some coverage. Um, it's really important to talk with an agent who understands these things. That's something else that I see is that a lot of agents don't. They just sell one kind of policy and they hear that you're doing a fix and flip and think, oh, yeah, sure, I can help you, when really they shouldn't be helping you.
So the two types of policies here is the builder's risk and the other one you said just a normal owner's policy with an endorsement.
A homeowner's policy, yeah, with an endorsement. Companies like Foremost will do that. I've seen some agents write through Safeco. Those just aren't the best always.
Right. So the endorsement, did I hear you right that if you have the owners with the endorsement and you are complete with your rehab, you list it on the MLS, you're trying to finish your fix and flip out by selling it, you are not covered from that point you have your permits closed
It's
out?
not always that way. It depends on the policy. It depends on the company. And so you need somebody who knows each company individually and can tell you which one is going to work for you. That's where I see a lot of people get into a sticky situation. The other thing that I see fix and flippers not really think about is when they're doing something that is structural. And so many people are wanting to put those beams in the kitchen now to make it so that it's open, and you have to have the right policy for that. If you're doing something structural, a lot of times it's going to require an engineer's letter that is stamped, and your scope of work needs to be submitted as well. And that can take some time. And so these aren't policies that you can get overnight sometimes. Sometimes I've been able to, but I can't always work that magic.
So on the builder's risk, is there liability coverage in that?
Depends on the policy. So I actually have one company where I have to purchase a separate policy for general liability. And so it's really dependent on the company and the policy. Liberty Mutual will include it, whereas US Assure will not.
So for the listener, read your policy, or because no one does that, let's be honest with ourselves, or have
Yeah.
an agent that knows what the heck they're doing.
Yeah. If you're only going to read one part of your policy, I recommend reading your exclusions, because then at least you know what's not covered and you need to get something else somewhere else.
So is everything included unless it's excluded?
It depends on what kind of form is written. If it's a basic policy, no, that means that you're actually getting whatever is written, that will
Right.
be included.
Yeah, that was my understanding as well. I know now title insurance is a bit different because in title insurance, everything is insured unless it's specifically excluded from the policy, which is why on the commitment you have
Yeah.
X number of exclusions, right?
Yeah. Well, you can have some policies like that with home products, but not basic. Just remember that word. That means it's basic.
We do not want basic insurance.
Well, you do. That's actually what a builder's risk policy is going to be. So you're going to have actual cash value, which everybody, the high alert is raised when you hear that after knowing about the fires here in Colorado. But for builder's risk policy, it's going to be actual cash value for the property itself. And then the work will be replacement cost.
So, I want to I want to get into this because this is very interesting, and I think people don't understand it. The difference between replacement cost and cash value. So, I want you to explain the difference between those two, and then if I'm doing a full remodel, isn't the replacement cost the cash value? So, first, explain the difference, and then I'd love to hear
Okay.
your opinion on that.
So actual cash value, the way that I can explain it so that everybody gets it, those are your Craigslist prices. Everything's depreciated and it's cheap. Okay. So that's what you get when you have a claim. You get actual cash value, you get Craigslist. Whereas if you have replacement cost, you're getting everything brand new. It is going to replace it item for item.
I've never heard it described like that. It's the Craigslist value. So the way I describe it is, let's say it's a roof and it's a 30-year roof. 'Cause, roofs are a great example because they tell you how many years the useful life is. So
Right.
it's a 30-year roof, and we're 15 years into that useful life. Well, now your roof is only half the value.
Yep.
So that's how I would explain it. But I love the way you just said that with the Craigslist. So what would it actually sell for in the market?
Yeah. Well, and even then,
But
the
you're not
market
taking a
will
roof off
price
and selling it
higher
away.
than insurance. So
Yeah. So
we're talking cheap.
we're looking for replacement costs at Pine. Like when we do a loan, we require a replacement cost because we want to know that we could fix the property, right?
Yeah.
So it's
So what
typically a
we
little
do
more expensive.
what we typically do is we get the loan value. We make sure that we're insuring it at least to loan value, and then we put on top of that the project amount. And so, you're going to get the amount that that property would be valued at that way.
But you very specifically have to have replacement costs because I mean, unless there's a total loss, I mean, you're going to get depreciated uh,
Mhm.
on your proceeds.
Yep. And honestly, most builders risk policies will not do replacement cost. You just need to make sure that you're pricing it right and that your agent is helping build out a replacement cost estimator, submitting it to the insurance company. Everything just needs to be right.
Yeah, and I've noticed lately that the replacement cost evaluator or whatever that system is you all use,
Uh huh.
those estimates are coming back like pretty wild.
Yeah.
They're not
Well,
really
I'm so
lining up with
glad.
what the market is.
Well, it's good though. It's good that they're increasing those limits. When we had the Marshall Fire here, all of those estimates were they weren't zip code specific. And so you'd have Alabama prices for somewhere here in Colorado that wasn't jiving. We were way underinsured when that fire arrived. And so now they have bumped up the replacement cost evaluators. I'm really grateful for that because it's going to help people be better insured.
Would you recommend me? I have a portfolio of rental properties. Would you recommend that I go through and reevaluate all my insurance policies and make sure with the values and the cost to replace going up that I adjust my policies?
100%. Based on, so one of the things that I do is I will reach out to a contractor yearly to see what rebuild prices are. Rebuild prices are going to be very different from build prices because you're bringing in cranes, they're lifting things over the neighbor's gates, and it's a lot more labor intensive, and you're not getting things in bulk prices. So now we're estimating that rebuild is anywhere between 400 to 550 a square foot. So, it would
Oh,
be a
that's
good idea to
insane.
reevaluate. Yeah, it's a huge difference.
Okay, and everyone listening to this could say and saying to themselves right now, I could do it for half that price.
You know what? I bet you could. But it's wise to have the right insurance.
Yeah, interesting. All right, so take me. I know we zipped right past this, but I want to go back to that vacancy piece because this is the mistake I see most people making. So, can you explain again what the vacancy clause is?
A vacancy clause makes it so that you actually are going to get replacement cost. Well, you're still going to get ACV on most policies, just so you know. You need to be at peace with this ACV idea because that's usually all that's offered. With a vacant policy, it drops your coverage significantly, or it can make it so that you don't have coverage at all, depending on your policy. So you need to read that, read your exclusions, and then. Well, I can give you a really good example. I have a client who just passed away, and her daughter reached out to me to see what she needed to do with her house that was left. Immediately, we needed to. I quoted out a vacancy policy because no one's in there anymore. And I think it's after 60 days, your coverage may not be there anymore. So make sure that you are changing to the right policy. If you're doing your fix and flip, it's actually important for you to also realize that they prefer vacant over having it occupied. And if you're going to have it occupied, there are very few companies that will actually allow for that.
So, you said 60 days and no insurance, which I have seen that, but I think you're lucky if you get that.
Yeah,
The ones that I've read quite a few of these policies. I know I'm a
it'll be
nerd.
30.
30.
Yeah, yeah.
Who in the heck is going to buy a fix and flip, rehab it, and sell it in a 30-day period?
Uh-huh. That's why you want a
Nobody.
builder's risk policy.
That's right. That's right. And a lot of agents, as you said, Shauna, don't understand this. they
Mhm.
understand normal, regular insurance, and so they're gonna say, are you living, are you occupying the property?" And the investor, of course, says, "No." It's like, "Great, you get a landlord policy." And they just they're just trained to go to the landlord policy, which all of them have a vacancy clause.
Right. They do. Well, one of the other problems that I see is that some investors are not forward thinking for the worst case scenario. Well, what if you can't sell that for quite a while? The company that I mentioned earlier, US Assure, will actually allow you to extend that policy up to 3 years having it vacant. And that's a big deal, especially for tract home builders, because they'll have an entire neighborhood that may not be, it's just sitting there. You want to have it properly placed.
So if you back to your rehab is done, and if you don't have the right insurance policy, and now you need to insure a totally complete, ready to move into house that's sitting in the MLS,
Mhm.
just go out and get a new policy, or what do we do in that case?
You'll get a new policy. Go get a vacant policy. And when you're doing that, you need to also realize that there are going to be different payment schedules with these type of policies. Some will do it for 12 months and they will allow you to prorate the policy so that you get premium back if you sell it before that 12 months is up. But you need to be aware that there are companies out there where that doesn't happen. If you pay for 12 months, that premium is completely gone. You don't get it back.
Yeah, I was just it's so crazy you said that because in my notes right here, I said, "Can you explain the difference between fully earned and a refundable policy?" So
Mhm.
what you're talking about is a fully earned policy. We
Yep.
want to avoid those as investors.
Not always. Sometimes that's the best choice for you, especially if you're doing some of your structural elements, because you just want the best policy when you're doing something that hefty. I have a client right now who's doing a pop top. Definitely recommending that kind of coverage for him because he's going to pay an extra $2,000 maybe and won't get it back, but he has the best coverage possible for something that extreme. So, again, talk to your agent. It depends on what you're doing.
So if my agent is not Shauna and I'm not in an area that Shauna works, the question to the agent is, should I be getting a fully earned or a refundable policy? And make sure you understand the difference because look, we're a fix and flip. We might be out of that thing in 3 or 4 months and we're doing a 6 month or a year policy. That's a lot of premium unused,
Yeah,
right?
I think actually a better question might be how many fix and flip policies do you write each month? If they're not writing at least a few every single month, they have no idea what the policies are for.
They probably never read it.
Yeah. They haven't read it and they don't know the companies.
And there's not that many, like you said.
No, there aren't.
Okay, I want to go back into the liability and then I want to get into some of this other insurance because you do it all.
Yeah.
On the liability, I often say, a vacancy policy or builder's risk policy is going to be far more expensive than a regular landlord policy because if you think about it from the insurance perspective, what's safer? A rental with a family living in it or a
Yeah.
property with power tools and ladders and, contractors?
Hmm.
Obviously, the power tools on the ladders is not as safe. So
You
there's
think?
some liability risk here. Now how do I protect myself from him falling off the ladder or hurting himself or any of that?
Okay. So you need to do a little investigating. And this is actually something that some of my carriers are asking for now, too. They want to know your contractor's name, they want to know how many claims he's had in the last 10 years. They want to know how many projects he's done within the year span. And then for you personally, you need to be getting a certificate of insurance and making sure that you're added on there as an additional insured. And then in addition to that, you also need to be making sure that he has workers' comp insurance because if he's hurt on the job, now his insurance will take care of it, not yours.
So the certificate of insurance, is that his insurance that I'm getting added onto?
Yep.
And that's
You're going
different
to
than
get added
workers' comp.
onto his workers' comp and his general liability.
Okay. I haven't seen a ton of the workers' comp stuff, but I do know that if you're working with licensed contractors, they do have a GL policy, general liability.
Yeah.
And if
And
it's
they
a big
should
project,
have,
you should get added on.
yes,
Honestly, in the real world, that doesn't happen on these little 30, 40, $50,000 remodels. You're in and out.
it's so easy though. All they have to do is call their insurance company. My contractor clients, they'll just text me the information. They just need your name and your address, and they can add you right onto the policy. Done. And then you get a copy of their certificate with your name down in the left-hand corner, and it's finished.
So if they
Super.
hurt themselves, you're covered.
Yeah, you're on their policy and they're not going to come after you. There are other endorsements that we can add to it. It gets a little complicated, but that's something to definitely ask your agent about. If you're doing property investing, it would be wise to sit down with your agent and find out a little bit more about certificates so that you can have them written correctly for each one of your projects.
What about the slip and fall?
Meaning with one of your contractors or with somebody who's in there?
Maybe the contractor forgot to shovel that day,
Uh,
and it's
you
somebody
as
that's
the
just walking by
homeowner.
in the neighborhood.
Right. You as the homeowner here in the state of Colorado, you are legally the one who is responsible for that. So you have to have enough liability. Typically, with my builder's risk policies, I'm adding about 1 million of liability on there. The lowest that I go is 500,000 because medical is expensive, and so that's probably that. And then the replacement cost. Those are your two biggest coverages with any home type property policy.
Yeah, I agree. And there's some policies that don't have that liability coverage,
That's
which
right.
is crazy to me.
Yeah.
We require liability if we're doing a raw land, raw lot. I mean, there's nothing there. We still require the liability policy.
Yep. You can get a builder's risk policy for that too, by the way, if you're going to be building anything on it.
Yeah, usually you do the liability until the construction, and then you change, right? Because
Right.
you want to ensure the structure. We
Yep.
say after foundation is probably appropriate, but liability
Yeah.
up until that
Some
point for
people,
sure.
they'll do it when the road is going in. So it depends.
Oh, this is all infill stuff. We're not doing our clients do infill. We don't do like big developments, but that what
Yeah.
you're saying makes sense. This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short-term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com. All right, what happens? I ask you about property insurance before we get onto this life insurance and building wealth stuff.
Um, I think one thing that people might not think about with their projects, they need to find out what the term agreement is with their lender. Because I've seen some that require a 6-month property policy and some that require 12 months property policy. That can make a huge difference in your premium and your cash flow with your project. I've seen it go from 2,000 to over 7,000 because the mortgage lender was requiring a 12-month premium, and the type of policy we had was one of those that would not be refunded.
Oh,
So
geez.
you need to find that out.
So understand your lender requirements.
Hmm. And you need to give those to your insurance agent right away. The best advice that I could give you with your project, get your lender and your agent connected
Yeah,
immediately because
yeah,
they'll do the work. They'll find out for you.
yeah. That's how we like to do it too.
Yeah,
We would much rather deal directly with the agent, just faster and cleaner.
it is. And they'll take care of it for you, and you have one less thing to worry about.
I have this interesting story to share. So this was maybe a decade ago, maybe even
Mhm.
more. It was down in Colorado Springs. We did a loan on a property, and the loan defaulted, and so we had to foreclose. But we were not able to get access to the property. The normally we can get when during the foreclosure we can get in there and protect the property, winterize it, or change the locks or whatever. They wouldn't let us in.
Mhm.
They were still trying to whatever get through the project. Well, at one point they just decided to give up. Didn't tell anybody. Turned the heat off. Left all the water on. And so we had a flood, right? The pipes burst and we had a flood and we had some significant damage.
Mhm.
So we were listed on the insurance policy and filed a claim, and we got denied. We got denied the claim because there was owner negligence.
Yep.
What are your thoughts on that one? Like, what good is the insurance for the lender and being added as a mortgagee if it doesn't insure you?
Well, so I'm in the insurance industry, so I automatically think, yeah, I can see that. But I also think that there was a piece that was missing, that you weren't allowed in the property. And so for me, I mean, it almost seems like you might have a case for a lawsuit to be able, because they shouldn't have been able to make it so you didn't have access, especially if you had ownership at that point. So,
Well, we were not the owners. We were in the process of repossessing it. So the foreclosure
oh,
process takes about 5 months. We
so
were
then
in that 5-month window.
technically what should have happened is, or what could have happened, I won't say should, is that that insurance company could have accepted that claim and then subrogated and went and sued the other company because they were still the owners. So, or you could have filed a claim through them because they were still the owners.
That's where we filed the claim. It was their policy that we were the mortgagee.
Yep. You have to have insurable interest, which means you have to be the owner at that point in time when the loss occurs.
So what does a mortgagee clause do then? I mean, we've had many, many claims, and I know I'm on listed on the check, but
Mhm.
I don't have any, I guess, outside of getting name listed on the check when there's proceeds, there's really no benefit then.
No, there is. It's the exact same thing as being added as a certificate, the additional insured on your certificate. It now makes it so that you have the ability to file a claim and you can do some of the things with the policy because you get the same coverage as somebody else, right? So, mortgagee clause is beneficial. It gives you some voice.
And you can get denied if there's negligence that you had no control over.
I don't think that that's what they should have denied it for, though. It sounds like really it should have been denied because you didn't have insurable interest. You weren't the owner right then.
No, but I was a mortgagee.
What's that?
I was the mortgagee.
Yes, but it sounds like you didn't have any kind of ownership. The bank did not, right? You
Yeah,
guys.
but you just told me that I could file a claim on the owner's policy when there's damage.
If you if they had owned it and you were on there as the mortgagee,
They
but
did own it.
they hadn't turned over ownership yet because you're going
They
through foreclosure. That's
yeah,
what you
so during the foreclosure process, they maintain ownership,
Yeah,
and we maintained the policy. We kept the payments current,
right.
and we were listed as the
Insurance world,
mortgagee.
you have to be owner to be able to have valid insurance.
Yeah.
That's insurable interest.
So here's what I learned 10 years ago.
Yes.
When they default on their insurance, get a new policy that protects you as a lender and forget about them.
Yep.
It's like forced place insurance. Okay.
Amen. I agree. And then they hustle pretty fast to get new insurance because it's
It's
expensive.
expensive, yeah. Or they just throw their hands in the air because we're foreclosing on them anyway.
Yeah, that's true.
Okay, so let's get into your other stuff because I know you're really into this infinite banking and you're trying to help people build their wealth and save for retirement and all of that. We have a
Yeah.
little bit of time here, so tell me about this.
Infinite banking, it's also called bank on yourself, be your own bank. It is a way that you're able to utilize your cash value during your lifetime. So that becomes it's accessible to you all the time. It's like having a supercharged Roth IRA where you're able to not have limits. You can get access to money before you're 59 and a half years old. You can put in as much as you want. You just have to structure it correctly from the get go. You can structure it so that it is fully funded within 5 years. You don't have to put in another dollar, yet that money is available to you. One caveat I would add is that that also will depend on the company. As you're structuring an IUL or a whole life policy, you need to make sure that you know when that specific company will allow you to have access to your money. Because I have one carrier that will allow it within a week. I have another carrier that wants you to leave it in 3 years. I have another that says 1 year. So that's something to be aware of. Um, I guess the best way for me to talk about it, though, is to tell some of my clients' stories
Yeah, let's
and
hear that.
how it's benefited them. One of them is actually my best friend, and she has funded an IUL for her little guy. He's 1 years old now, and she does that with $250 a month. This is going to replace a 529, where this money is going to continue to grow with compound interest as he gets older and older. By the time that he's 20, he's going to have, I think it was like $64,000 available to him for college. And as he gets older, by the time he's 65 and is ready for retirement, he's going to have over 1 million. That's what it's projected to do.
And that's $250 dollars a month contribution.
$250 a month. Yep.
What's the rate of return on that? 'Cause you gotta add
Historically,
compounding.
it's been about 7%. Uh, I have seen one of my clients last year had a return of, it was 12 point something percent, which is a great return.
Mm.
Um, and then, it just depends. If the market is up, it's going to be going up with it. If it's down, it stays right where you're at. You don't lose any money. With the ones that I write, if you're with any variable products, it will go up and down and you'll lose money with, just like the stock market.
So it's a whole life
It can
policy.
be whole life, it can be indexed universal life policy. The difference between those, with a whole life policy, you're going to get a whole bunch of guarantees, but you have to pay for those guarantees. And so if you're super set on safety, that's the way to go. If you are more on the risky side, and I'm not saying that it's significantly risky, but it's a little bit riskier because there are going to be some downside years. IULs actually, all of the carriers that I've spoken with, they told me that their IULs outperform whole life with cash value growth.
Because more of the money is going to the investment probably.
That yeah, and it's not necessarily an investment, it's the index.
Right, but it's not going as to a premium on a term or a
It
life
is
insurance policy. It's
you're
more of an
structuring them so that it's as little life insurance as possible with as much cash value as possible.
gotcha. Okay, and so what's the benefit of that over an IRA?
You have so much more control. That's really the main benefit. You're able to access that money. You don't have to, you could do the work on your property and not have to, that's not one of those structures that you have to be confined by. You can put in as much as you want. You don't have limits. Some of the other, I mean, huge one. If you have $500,000 in your IRA and you die, that's what gets left to your kiddos. But if you have $500,000 cash value in a life insurance policy, you could have 1 million or 2 million, depending on when you started it, of tax-free money that will be left to your kiddos. That's a very big difference.
So does that avoid estate tax?
Yes, it does. Yes, and you can incorporate it all into your estate plan as well with your estate attorney. I work with a few estate attorneys where we put all that together.
And that estate tax limit is coming way, way down, like half of what it is right now.
I know. Yeah,
So
yeah,
a
it is.
lot of people probably listening to this will fall into the estate tax, and it's like over 40%. It's very expensive.
Yeah,
So you get taxed when you earn money, and then you get taxed when you spend the money on sales tax,
yeah,
and then you die, and you have, by the way, personal property tax and real estate taxes and all these other, and then you die, and then you get taxed again.
yep,
Like, how much of your dollar do you actually keep?
like that much.
Yeah, it's pretty small.
Unless you plan accordingly, right? And then you can make adjustments. This
Yeah.
is one of those adjustments. One of the things that I really love about this too is that it allows you to create a tax-free retirement. That's a term that's thrown around all the time, but it's awesome. It's like the old-fashioned pension where you can turn on a guaranteed lifetime income rider and you could have yearly income every single year until you pass away. We can structure it so that it actually will go all the way until the last spouse dies, and you can have tax-free retirement for the rest of your life.
This does sound amazing. I think people will be interested in this. So I want to make sure I get your contact information recorded here. But before we do that, Shauna, I got a question for you.
What's that?
As we're recording this, there's a pretty significant storm down in Florida, and it's hurting people. It's definitely damaging property. It's clearly not the first one. I think a lot of this is because we're starting to build in danger zones,
Yeah.
fires in California, wind and water and flood in Florida. And it's right in the path of destruction very, very often. And then the problem with that is you build your house in that path and then it impacts all of our premiums, right? You made the choice to do that, but we're all getting impacted. So my question for you um, is there a way with these rising premium amounts to cover these damaged properties? Is there a way to reduce our premiums and still stay safe?
No. That's the bad news. I'm the honest girl. The biggest problem actually is that we have carriers who are moving out of states And it is impossible to insure some properties right now, even here in the state of Colorado,
That's
up
right.
in the mountains. We have a new state plan that will be going into effect next year, but that's leaving some of these properties vulnerable until that time. And when you have an estate plan, usually the coverage isn't all the way up to what you need it to be for your property because they've become so, I mean, $1 million is nothing anymore for a mountain property.
Mhm. I want to make sure we get your contact information, but I want to go through my notes real quick on what I learned from our little episode here.
All
We actually
right.
talked, obviously, we talked a lot of insurance, and I didn't get into your story at all, so I apologize for that. Normally, I want to get to know you a little bit better, but we just dove right in because there's so much to cover with the
There is.
insurance. Speaking of that, at our Success Summit, the actual original Success Summit is November 9th in Denver. So, you Denver listeners, November 9th is the Real Estate Investor Success Summit. That's the one that's been going on for well over a decade. We'll have over 300 people there. We have a panel at that event on insurance because of what I just said. All of the complications around insuring these danger zones, right? And how it's impacting all of us and different strategies we could do to try to stay safe, one, and two, save some money. So maybe once we hit pause on our recording, you and I could talk about that if you want to be part of that. But I wanted to get that out there, denveriss.com. So if you're in Colorado and you're interested in becoming a real estate investor, or you are a real estate investor, it still is the biggest and original Success Summit, November 9th. Find out more, denveriss.com. Okay, here's my notes. There's two types of policies for your real estate investments when you're fixing and flipping. You have your regular owner's policy with endorsements. It's a vacancy endorsement, it sounds like, and builder's risk. Builder's risk tends to be a little bit better because of some of the things we talked about, covering it after it's completed, the transit endorsement you mentioned. So I would definitely talk to your real estate agent or your insurance agent about the different types of insurance because look, even Shauna, the expert, couldn't answer some of my questions because it really does depend. Each situation is going to be different. And I doubt you're reading your policies, by the way. So, what else did I put? You talk to your agent. I wrote that down twice. Know the difference between fully earned and refundable policies and when you would want to use one or the other. And you also said a piece of advice, know what your lender's requirements are, because if you need a 12-month requirement, do you really want to go to the fully earned policy if you're only going to be in it for 3 or 4 months? That could cost you an extra, she said, between seven and I think it was $2,000 or $3,000. Big difference in the premium amount. Get added to the GL and workers' comp insurance for your contractors. Understanding lenders' requirements. I just said that. Infinite banking is maybe better than IRAs because it's way more flexible and can create tax-free retirement. The strategy of using it to replace a 591 or a 529 was also brought up. How did I do?
Right. Yeah, you did very good.
All right, tell us how to get a hold of you.
All right, you can reach me by phone. You can text me or call me at 720-389-7651. Or you can always hop onto my website. And our website actually has a tab just for builder's risk. So if you need that, go fill it out and we'll get a quote for you right away. That's www.FRI, like front range, insurancesolutions.com.
And where are you licensed?
I am licensed in Colorado, California, Texas, Michigan, Utah, whole bunch of
So
places.
quite a few. Okay,
Yeah,
great. Specializing in working with real estate investors. So if you're a real estate
correct.
investor looking for an insurance agent, not the real estate agent, an insurance agent, be sure to reach out to Shauna. All right, one final piece of advice before we close out here.
You know, this is probably not what you're expecting, but I'm actually going to put a shout out for a Facebook page that I'm a part of. It's called the Contractors of Colorado page, and they have 19,000 members, and it's growing rapidly. I am their verified, trusted commercial insurance agent there. I see a lot of property investors hopping on. You should be joining because they have an amazing amount of contractors available there. And they have a verified list of contractors that I can help you to find that have gone through an extensive process where we've checked their insurance. We've looked through a bunch of other things. We know these guys are good.
Oh, that's
You
awesome.
still
So
have to do your due diligence though.
Yeah, and I actually just got invited that one of the guys in my EO group I mentioned to you right before we hit record. He owns a cabinet company and he's been getting a ton of business out of this group. So I know it's super active. So it's the Contractors of Colorado Facebook group, right?
Yep. It's amazing. I love it.
All right. Well, I want to say, first of all, thank you so much, Shauna, for your time. I know you have a lot of other things you could be doing, and you chose to spend about 40 minutes here with me today talking insurance. I know you love it, but we really, really do appreciate your time. And for you, the listener, you could be doing so many different things as well. And you chose to spend 40 minutes with us. So we appreciate you. And with that, I want to make sure I say, I hope you make this day a great one. Thanks, Shauna.
You're welcome. Bye-bye.
Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.